Okay, when it comes to investing, it's not just what you invest in, it's where you hold it. This morning in Matt on the Money, we're talking about tax-efficient investing and a strategy called asset location. And Dan Bennett from Blakewater Advisory back with us. Dan, I want to start simple for this one. What does asset location mean, and why does it matter for everyday investors?
So very high level, we've got stocks and bonds, say for instance, and then you have your different account types. Traditional 401k, tax deferred, Roth, and taxable accounts.
And this is when you get taxed on those accounts.
Right. So asset location is just simply where those types of investments are being parked in those types of account types to minimize your taxes and to maximize after-tax returns.
I think that's so hard for people to kind of game out because they don't necessarily know what income bracket they're going to be in when they get to that retirement phase. They can look at what they're earning right now and they know what their tax bracket is. But what do you tell people when they're not sure how much I'm going to be bringing in 30 years from now?
Well, I think that's where tax optimization planning now within your investment account types is so important. There's a term that's called tax drag, where if you have, like a brokerage account, let's just say taxable brokerage account, and you hold assets like taxable bonds that might yield 4 or 5% in those types of accounts, you're being taxed on that interest every year, even though you're not selling it. So we want to make sure that, okay, if you're going to hold bonds, that those are being held more in tax deferred accounts, and we're not increasing artificially your income today when you don't necessarily need to.
Okay, so how should people think about what belongs in like a taxable account, like a brokerage versus a traditional 401k or IRA versus a Roth?
So in my opinion, I think that taxable brokerage accounts should be the most tax optimized, where we're not including like, dividend paying stocks or high yield bond funds or any type of real estate. Tax deferred, if bonds make sense within your overall asset allocation, that's where those should be parked. And then tax free should be your most aggressive. So like your Roth, or let's say your Roth IRA or your Roth 401k, stocks, international, small caps, that's where, we've got years and years of tax-free growth. You might want to benefit from those more aggressive asset classes.
For people who have a goal, let's say, of like retiring 10 or 15 years early, is the brokerage where you kind of tell them to focus?
So it's your Swiss Army knife account, where it's not necessarily a hammer where it has to be used for one thing. It can be used for college education for the kids down the road. It could be used for retirement. It could be used to pay for early retirement, let's say COBRA bills, if you're
kind of like medium-term
so.
medium-term goals, right?
Yeah, medium or long-term, depending on how you want to structure it.
So. Are there certain types of investments like dividend payers or bonds that really benefit from being in the right account?
Yeah, so those are, again, those are where those tax-deferred accounts are really going to play. So if we look at sort of asset allocation, which is how your money is actually being invested, let's say you're, traditionally like a 60-40, right? And you have those three different account types. You can do what's called, like a mirrored approach, where you have 60% bond, or excuse me, 60% stock, 40% bond in a 401k, 60-40 in a Roth, 60-40 in a brokerage. Or you can say, okay, let's say I've got $300,000 and I've got $100,000 in each of those accounts. We could look at this optimally and say, okay, $100,000 or 100% in a brokerage account, 100% stocks, 0% stocks in a 401k, and maybe like an 80-20 mix in a Roth account. You still have the 60-40 overall asset allocation, but we're optimizing where those asset classes are being held.
So it sounds like if your tax situation is that complicated, right? If you've got that many accounts, it's probably a good idea to meet with somebody.
I think so. I mean, 90% of this, like, asset allocation is going to be the most important, and then on the fringe, asset location is where that'll come into play.
Such a smart way to think about investing. Really something that, a lot of people overlook. So Dan, thanks as always. We'll have you back soon.
Okay.
More Good Day after a quick break.